You think you know what money is. You hold it in your hand. You see it in your account. A comfortable, solid, dependable thing. A tool. But it's not. What we call money today is something else entirely. It's a ghost. An idea. And most of it, nearly all of it, wasn't created by a government or dug from the earth. It was born in a quiet room with the stroke of a pen. It was created the moment someone, somewhere, signed their name on a dotted line. The moment you signed for your car, your education, your home. You didn't just borrow money, you summoned it into existence. The story we are told is simple. It's almost a nursery rhyme. We earn money, we put our savings in a bank. The bank then takes that money and lends it to someone else who needs it. A responsible, circular system. A safe box for our collective wealth. But that story is a lie. It is perhaps the most widespread and consequential misunderstanding of our time. The truth is that banks do not lend out deposits. They don't lend out other people's money. They create new money every single time they make a loan. So if the money isn't coming from a vault full of savings, where is it truly coming from? And what does it mean to live in a world built on a foundation of phantom wealth? To understand our world, you have to go back to a simpler one. A time of merchants and trade and a very real problem. Gold, it was the ultimate money. Heavy, pure, and trusted. But carrying it was a burden. It was a risk. So people sought out the safest place in town to store their treasure. The local goldsmith. He had the strongest vaults, the most secure locks. For a small fee, the goldsmith would take your gold and give you a paper receipt, a promise that you could redeem your gold at any time. Soon, a brilliant realization began to dawn. People didn't trade the gold anymore. They traded the receipts. The paper was just as good as the metal, but infinitely more convenient. It was a revolution in commerce. But the goldsmith noticed something else, something far more profound. He would look into his vault day after day and see the same gold coins sitting there, collecting dust. People rarely came to claim their actual gold. They had faith in the paper. And in that faith, the goldsmith saw an opportunity, a temptation that would change the course of history. He began to write new receipts for gold that he did not have. He would lend these new, fictitious receipts to borrowers and charge them interest. As long as everyone didn't show up at once to demand their gold, the illusion was perfect. He had discovered a kind of modern alchemy. He was creating spending power from nothing but confidence. This was the birth of a system, the birth of fractional reserve banking. For centuries, this system, this elegant deception, was tethered to the real world. That paper promise was always, in theory, convertible back into a lump of physical gold. The ghost was chained to a metal body. It was a check on the system's power, a governor on its speed. It meant there was a limit to how much money could be created. But in the late summer of 1971, the world changed forever. In a single stroke, the United States government severed the final link between the dollar and gold. The anchor was cut. The ghost was unchained. From that moment on, our money, the world's money, became what it is today, a fiat currency. Its value derived not from a precious metal, but from a government decree, a shared belief, a collective act of faith in the numbers on a screen. So what does this mean for you today? Let's walk through the modern miracle. You want to buy a house. You need a loan for $500,000. You go to a commercial bank. You present your financial life, your income, your assets, your credit history. The bank reviews your application. They decide you are a worthy borrower. They approve the loan. What happens next is the secret at the heart of our economy. The bank does not check its vault for $500,000 to give you. It does not look at its list of depositors and find someone with a spare $500,000 to transfer. It does something far more strange and powerful. A loan officer opens a computer program. They create a new account in your name. And into that account, they type the numbers. 5, 0, 0, 0, 0, 0. In that instant, 500,000 new dollars have been added to the money supply. They did not exist a moment before. They were created from nothing as a debt, a liability for you, the borrower, and an asset for the bank, the creator. This is the crucial paradox. Loans create deposits, not the other way around. The act of borrowing is the act of money creation. And this new money now floods into the economy. You buy the house. The seller deposits that new money into their bank. Their bank now has more reserves, allowing it to create even more loans, which creates even more deposits. It's a chain reaction, a feedback loop of creation. When millions of people are doing this at once, the effect is staggering. All this new money chases the same number of houses, the same number of cars, the same number of goods. Prices begin to rise. Asset bubbles inflate. Real estate in major cities soars to impossible heights. The stock market detaches from the reality of the underlying companies. Everyone feels richer. Prosperity seems to hang in the air. But this prosperity is built on a fragile foundation, because every dollar created is also a dollar of debt. And that debt comes with a cost. Interest. This means that more money must always be paid back to the banks than was originally created. For the system as a whole to survive, the money supply must constantly expand. Lending must always grow, faster and faster, just to pay the interest on all the loans that came before. It is a system that demands exponential growth, forever. It's a treadmill that can never stop. If lending slows, if people lose confidence and stop borrowing, the creation of new money falters. But the old debts, and the interest on them, still demand to be paid. There is suddenly not enough money in the system to pay what is owed. Defaults begin. Businesses fail. People lose their homes. The bubble doesn't just deflate, it bursts. The entire structure, built on a cascade of promises, can collapse in on itself. In 2008, the treadmill stopped. For years, the machine had been running at a fever pitch. Money was easier to create than at any point in human history. Banks had been creating trillions of dollars in mortgage loans, often with little regard for the borrower's ability to repay. Why? Because they could package these loans, these promises, and sell them to other investors around the world. The risk was passed on. The profits were kept. The housing market became a casino, fueled by the endless creation of new money. But no tree grows to the sky. Eventually, reality hit. Homeowners, burdened with loans they could never afford, began to default. The trickle became a flood. The houses, the physical assets that were supposed to back all this phantom money, began to lose value. Suddenly, the numbers on screens all over the world, the complex financial instruments built on top of these mortgages, were revealed to be toxic, worthless. The trust that holds the entire system together evaporated in a matter of weeks. Banks looked at each other not as partners, but as existential threats. Who was holding the bad debt? Who was secretly insolvent? No one knew. So they stopped lending to each other. The credit markets, the arteries of the global economy, froze solid. Money creation ceased. The machine that must always grow suddenly slammed into reverse. The world watched in horror as financial giants, institutions that seemed as permanent as mountains, crumbled into dust. It was the moment the ghost in the machine materialized, and it was a monster. In the panic, Governments and central banks faced a choice. Let the system collapse and cleanse itself in a firestorm of bankruptcies, or intervene on a scale never before imagined. They chose to intervene. But how? They couldn't use taxpayer money. There wasn't enough. There wasn't time. So they turned to the one entity that holds the ultimate power: the central bank, the Federal Reserve. And what did it do? It did exactly what the commercial banks had been doing, but on a godlike scale. Through a program called quantitative easing, the central bank created money, trillions of dollars, with a few keystrokes. It used this new money to buy the toxic assets from the banks, to inject liquidity, to prop up the very institutions whose recklessness had caused the crisis. This was the ultimate revelation. The system of money creation had failed so catastrophically that the only solution was to use an even more powerful version of the same system to bail it out. They didn't fix the machine. They just flooded it with fuel to force it back to life. The creators of the illusion were saved by a bigger, more powerful illusionist, and the world was changed forever. The crisis of 2008 was supposed to be the Great Reckoning, a moment of clarity, a lesson burned into the memory of a generation. We were told the system would be reformed, that the excesses would be curtailed, that this would never happen again. But that is not what happened. The emergency measures of 2008 never ended. They became the new normal. Quantitative easing, once a radical, untested policy, became a standard tool in the central banker's kit. Interest rates were slashed to zero and kept there for a decade, making borrowing, and therefore money creation, almost free for the largest corporations and banks. This vast ocean of newly created money had to go somewhere, but it didn't flow into the real economy. It didn't fund a wave of new factories or bridges or scientific research. It did not trickle down into the wages of ordinary people. Instead, it flowed directly into financial markets. It sought the quickest and easiest return. The stock market soared into the stratosphere, completely disconnected from the health of the economy on Main Street. The prices of bonds, of fine art, of luxury real estate in global cities all inflated to historic highs. We entered the era of the everything bubble. This has driven the deepest wedge in our society. It has created a two-tiered system. Those who own assets, stocks, property, investments, have seen their wealth multiply beyond their wildest dreams, carried aloft by the tide of central bank money. But those who only have their labor to sell, those who live paycheck to paycheck, have been left behind. Their wages have stagnated while the cost of living, especially the cost of housing, has been pushed ever higher by the very same tide. This is the source of the deep and growing anxiety that defines our time, the feeling that the game is rigged, that the ladder has been pulled up. We did not fix the flaw in the system. We amplified it. We made the entire global economy more dependent than ever on the continuous creation of new money and the relentless inflation of asset bubbles. The ghost in the machine is now larger, more powerful, and more deeply embedded in our lives than it was before the last crash. And so we find ourselves back where we started, with a signature on a document, an act of trust, a belief in a promise. Our entire modern world, with all its technological marvels and complex societies, is built upon this foundation. Not of gold, not of steel, but of pure confidence. Money is not a thing. It is a story. It is the most successful and pervasive story humanity has ever told itself. A collective fiction that allows billions of strangers to cooperate, to trade, to build. It is an operating system for human society. But we have allowed the operating system to become corrupted. We have built a system that requires infinite growth on a finite planet. A system that privatizes profits from money creation while socializing the catastrophic losses a system that systematically widens the gap between the owners and the earners. This is not an abstract economic debate. It is the story of our lives. It is the reason a home feels out of reach for a new generation. It is the reason our savings seem to lose their value. It is the gnawing uncertainty that the ground beneath our feet is not as solid as we were led to believe. The story is beginning to fray at the edges. The trust is wearing thin, and it forces us to confront the most profound question of our time. What happens when a story this powerful, this all-encompassing, begins to end? What comes next, when we finally stop believing in the ghost in the machine? We have built a world on a promise, and we are all, collectively, waiting to see if it will be kept.